Yeah, I mean, I think it's coming. We just get impatient waiting for it, don't we? But I thought yesterday's data was pretty compelling. And we forget that the normal time from an inversion of the yield curve, which was roughly the middle of last year, to a recession is 12 months plus. And yes, but yesterday's leading indicators is really brutally bad, minus 1.2% month on month, down 7 and a bit % year on year. Every time you've had that in the US, you've had a recession. So I mean, it's coming, it's on its way, it's just a timing issue.
Sorry, how prepared is the market for this then? Because I think that's Jeff's question, isn't it? If not prepared, then it could be brutal, yeah?
Yeah, I mean, the market getting prepared. I mean, markets always sort of deal with the one debate in front of them. I mean, they don't look sort of 3 years ahead and 2 years ahead or even 12 months ahead. And I think what we've had in the last few weeks is really a response to the liquidity that came into the market on the back of the banking crisis. $400 billion, an expansion of the Fed's balance sheet, a slowing of QT for a few weeks, and therefore supporting equity markets as we've seen. But it's been a very narrow rally. There's not been a lot of stocks driving it.
I think you make an interesting point there, because what we do know is that the market is not the economy and the economy is not the market, and sometimes they appear to head off in different directions. But the conclusion, I think, from the bears has been that there will be a reckoning. The reckoning has just been postponed so far. How does that match up with your analysis of what ultimately we might see with profit margins, earning expectations, and the likelihood that actually equity markets can come through this relatively unscathed?
I mean, they won't come through it unscathed in our opinion. I mean, the reality is... I'm not even sure about relatively, but I mean, the reality is if you look at profit margins, they went to record highs in 2021 and a bit of 2022. And of course, when you have a lot of inflation around, you can get very good operating leverage. So you can get record high profit margins. So, you know, when you get into a recession, we've got to do a double hit on margins. You've got to normalize them back to normal levels, and then you've got to price in a recession. So I think the expectations for earnings are way too optimistic, and therefore the stock market will have to contend with that at some point.
There are warning signals out there in terms of market positioning for some sort of a lightening up on exposures, and you can see it in the transportation stocks, small cap as well. How much more is to come in terms of repositioning?
In terms of repositioning, I mean, I think people, you know, you can look at lots of things. If you look at sort of retail holdings of cash, there's a couple of indicators out there in the States. AAII give you one of them. They're nowhere near where they would be at a typical bear market low. In fact, they're not even halfway to where they should be. And you know, investors say they're pessimistic, and in some ways they are. And you know, look at the Merrill Lynch Fund Managers Survey, but I don't think they're properly bearish. When you get proper bear markets, you end up with despair. You know, people throwing their hands up in the air. They don't want to ever own equities again. We're certainly nowhere near that.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.